Good afternoon everybody, and welcome to today's video. In today's video I would like to tell you in what to invest your precious money. Because in my last video, see link in the description, I told you what you can reach with actually investing a couple of years and how you can calculate when you could quit your job, when you could retire early, just on a normal salary. But today I just want to tell you where to invest or in what to invest your money, so we were able to do that. So in what can you actually invest your money? Well, we look at the stock market. I don't do real estate or anything else, but if you look at the stock market, I think there are three main things, or at least three main things I want to talk about today. The first one is stocks, the second one is mutual funds, and the third one is ETFs. But I'm gonna explain every one of them, give some pros and some cons, so you know what fits you and what is actually a good pick. The first one on the list is stocks. What is a stock? A stock is a part of a company. You can buy it on the stock exchange. So let's say you want to buy a piece of Apple. You can, because Apple is listed on the stock exchange. So you are able to buy it. One of the big disadvantages of that is, well, if the company doesn't deliver, doesn't perform, the stock can go down very quick, very rapidly and very steep. But on the other hand, if the company does well, the stock can go up quite good, quite steep and quite a lot. But actually, to invest in stocks of single companies, you need a lot of time. You need to research what is the company doing, what is it making or producing, or what service does it bring, just to know and kind of predict, let's say, what it's going to do in the future. And also, putting all your money in one stock is even more risky. So for most people that will be a no-go. The second one on the list is the mutual fund. And what actually is a mutual fund? Well, it's an investment vehicle to buy investments. Let's say your name is Bert and you start investment firm Bert, investment vehicle Bert, and you buy stocks of Apple, Microsoft, Tesla, SpaceX, Nvidia and a dozen of others. At that time you have a nice diversified portfolio. If I want to buy shares of the investment vehicle that's called Bert, then I can. And at that point I already have a nice and well spread out investment portfolio. Because in that investment Bert, there may be 10 or stocks of 10 companies, but maybe also of 100 or 150. So that means that when the time is there that one of them goes bankrupt, there may be 100 others in there, which of that 100 maybe 95 may do okay and 5 may do extremely well. So that means you will have a nice and balanced portfolio. That also means that maybe you won't even notice that one of the companies that's in the mutual fund actually went bankrupt. Because if there are 100 or 200 or maybe even 300 in, you can't follow all these companies. So there is a big chance you might not be aware that 1 or 2 a year is failing. So mutual funds, a very good diversification for your portfolio, but it comes with high cost because it has management fees, because the managers want to be paid and they want to be paid very well. And typically the management fees for the mutual funds are between, let's say, 1% and 2.2%, which is very high. and that goes off of your investment gains, so you lose that. So think about that if you buy or want to buy mutual funds, that is one of the biggest cons, or the biggest con. Then we move on to number 3, and number 3 is the ETF, which stands for exchange traded fund. And what actually is that? Well, it's a product they made up. Because people want to buy an index. And what is an index? Well, an index is just a combination of companies. The most well known is the S&P 500, but you also have the Nasdaq or the MSCI World and many others. But you can't actually buy those indexes. So they made a product in the financial world to make it easier for people to buy the underlying index. If you buy an ETF, one of the biggest pros is that you have a very good spread, because let's say you buy an ETF on the S&P 500. The S&P 500 are the 500 largest companies of America. So if you buy an ETF on the S&P 500, you indirectly buy in on 500 of those companies. So that's a very nice diversification for your portfolio, and actually it's a very nice start for your portfolio. And even more actually, if you just load up your portfolio with an ETF on the S&P 500, you will do very well in the short term, mid-term and long term. And one of the other pros is that the costs, the management fees, are very low. I personally have one in my portfolio that only has a 0.07% cost. Compare that to the cost of mutual funds, which have between a 1 and 2.2%. That's quite a big difference. So yeah, something to actually consider very hard. One of the downsides of an ETF, I don't know. Maybe the only one is that, okay, they don't go up 60 or 70% in a year, which if you choose some stocks wisely and you win with those stocks, they can go up 50, 60, 70 or 100% a year, or maybe in 6 months. But if you just want to build up a nice, well-balanced portfolio, and you actually look for an ETF on the S&P 500, low cost, 500 companies, easy to buy, not a lot of work to maintain, actually no maintenance at all, very low cost, I would go for that. I would put my money on ETFs. It's actually made for investors to have an easy product and a well spread portfolio. So I would use that if I was you. But once again, I'm not a financial expert. This is not financial advice. This is just my opinion. Stocks, very risky. Mutual funds, a lot of costs. And ETFs, very easy to buy. Not a lot of cost. A good diversification and easy to maintain. So yeah, that was it for today. Thanks for watching, and until the next one.